In 2012, a private equity firm paid $59 million for a single retail unit in Manhattan. No apartments, no floors above it. Just the ground floor of a building on the corner of 5th Avenue and 57th Street. The space was 4,700 square feet. That's $12,500 per square foot. For a box with no views, no prestige address on the deed, and no residential upside. At the time, it was one of the most expensive retail acquisitions in American history. 3 years later, they leased it to a luxury brand for $25 million a year. Nobody talked about it. It didn't make headlines. It just quietly became one of the most profitable real estate plays of the decade because of where the walls met. Real estate has always been about location, but location is not a single variable. It's a hierarchy. And at the top of that hierarchy, above neighborhood, above floor level, above views, sits position on the block. Specifically, whether you own the corner. The difference in value between a corner property and a mid-block equivalent in the same building, on the same street, in the same market, is not marginal. In prime commercial corridors, it routinely runs 200 to 300%. In luxury residential, 15 to 30% is the floor, not the ceiling. In trophy asset markets, Monaco, Mayfair, Palm Jumeirah, the premium becomes essentially whatever the market decides it can bear. And it keeps bearing more. To understand why, you have to think like a retailer first. Foot traffic doesn't move the way most people assume. It doesn't flow evenly down a street like water through a pipe. It clusters, slows, and concentrates at decision points. Intersections are where people pause, where they stop to check a phone, choose a direction, wait for a light. That pause, measured in seconds, is the entire game in retail real estate. A mid-block storefront catches one stream of pedestrians from one angle. A corner catches two streams simultaneously from approaches that cannot avoid it. The brand on the corner is seen. The brand 40 feet behind it is passed. LVMH understood this with mathematical precision when they spent over $700 million acquiring the Tiffany flagship on 57th and 5th. The building had value. The brand had value. But what LVMH was really paying for was the corner. The right to occupy the most visible intersection in the highest net worth retail corridor on earth, permanently, and to deny it to anyone else. That's not retail, that's positional warfare. In residential real estate, the logic is quieter, but the money follows the same geometry. A corner apartment has two exterior walls. That means more light, more air, wider sightlines, and in the premium segment, almost always a wraparound terrace. In 2021, a corner penthouse on the uppermost floor of a tower in Monaco traded at over $100,000 per square meter. The equivalent interior unit in the same building was listed at $67,000. Same developer, same finishes, same building. The corner added 49% to the price, and it still sold in under 3 weeks. In London's Mayfair, corner mansions on garden squares command premiums that have held through multiple market cycles, including the 2008 crash and the post-Brexit correction. They lose value more slowly in downturns. They recover faster. They sell in less time. Because scarcity doesn't negotiate with market conditions. In any city block, there are exactly 2 corners. There are potentially hundreds of mid-block units. And developers can build more. You can add floors, you can convert warehouses, you can rezone and rebuild. But you cannot manufacture a corner. The geometry is fixed. The supply is permanently capped by the intersection itself. The corner isn't a feature. It's a category. And the people who treat it that way have been getting quietly, systematically paid in cities, in cycles, in asset classes. For as long as cities have had intersections, the math was never complicated. Most people just never looked at the geometry.